Hi everybody, this is Gary Dean with Sentiment Timing, and this is a free technical video report for Wednesday, July 17th, 2019. Sorry for the lack of free reports. It's been a pretty crazy time. I've been taking some time off, and we had the 4th of July, shortened week. So I'm back in the groove and getting these out. So we've had a pretty crazy run lately. Obviously, it's really no surprise the basis of the run has been the central banks really just jawboning rate cuts, and it's kind of a strange just situation because you have the Fed coming out as the S&P is making new all-time highs and saying how bad things are around the world, and that's why they need to cut rates. And we're really looking at a quarter point, maybe a half a point tops, and I've never really seen this type of euphoria for that. And when we had the QE coming out and then QE2, I mean, they were just flooding the market with cash, and that whole move made sense. This is a quarter point or 50 basis points, and one would think that we're really going into some type of QE3. It's kind of crazy. So let's take a look. There's a couple things that I wanna show you here. So first off, the overall call that we had as far as with our projections on what was going to play out got blown out. It actually everything looked like it was going as planned, and it was the day that when the Fed came out and said that they're gonna lower rates, that just sent everything into a tizzy. And then from there we actually had some other dates that we were looking for drops, and the crazy part about it is that when these drops started, we had Powell coming out and saying how he was going to lower rates, and these are the reasons why, and from there we saw just all out reversals and buy programs. So what I want to kind of just go over with this again, this is a September 25th 2018, and this is when the markets were heading higher. And what he was saying was that he still foresees a relief rally in November that may be followed by a decent weakness into year end. So this was on 9/25, and from there, that's when we saw the markets collapse. Now, I'm not saying that is going to happen in any case. There's going to have to be some type of catalyst to the downside because this market is just on a 50 basis point Fed buying frenzy. But right now, what we're looking for this week was always set to be a bearish week that Woody had mentioned. But it's what he's basically saying in this is that decline profiles have been delayed, but it does not mean it will not always be denied. So we have this. If we go back and look at the sentiment again, this was in September 25. 2018. So we got a drop, and from there, this was where we were looking for the drop to continue, and obviously we had actually it was in this area here we were looking. So we had the drop, and then we had the market come back up again, and just notice how we had the extreme bullish sentiment readings, and the quick drops gave us some quick bearish readings. So if we look at the chart now, we had this quick drop. We had 8%, and from there, everybody is bullish again. And that's all you hear on TV is, why this market's going to 3,500, 4,000. And, everybody just keeps pointing to the Fed. And like I said, it's only 50 basis points that they're really talking about. And they've basically have priced in taking away the entire Fed raising in from 2016 and 17, so or 2017 and 18. So it's been it's kind of crazy, but everybody is extremely bullish on this market. And if we take a look, the predictive analytics model, we're still bearish. Obviously, that has not played out, but as Woody said, it doesn't mean that it may be delayed, but it doesn't mean it's going to be denied. Short-term sentiment, we're in euphoria. Obviously, I just showed you on that chart. Intermediate term, we are in euphoria. So the price is probably limited to the upside, And if we get a larger drop than a lot of people are anticipating, it would not surprise me at all. Now, there were some warning signs that we put out in our report, and this was just yesterday actually, and the market was actually up when we put it out. But this is the advanced decline line, and this is just on a 60-minute chart, and you can see that it was diverging. So as the S&P was moving up, this was making a lower high. And what I had put is that, what this is hinting is that we are going to get some type of pullback, and that's pretty much what has played out so far. Now, this is it's the same NIAID chart. It just zoomed out a little bit because I wanted to show the S&P chart. And what I was showing was there was this bearish pattern in play, and this was the target that it was looking for. And we're getting pretty close to that target right now. So let's just take a look at the regular charts and some of the things that are just really blowing my mind. The Russell 2000, this is your risk on trade. This is still in bear market territory. How we are in, where every other index is screaming, but yet our risk on index is still in a bear market and hasn't made a new high since I was just showing. This is August of 2018. So we're going on a year that the Russell 2000 hasn't made a new high, and even worse, it hasn't even made a new high since May when we had this pop up right here. So something is not right overall with the internals of it, because this should be screaming higher. And right now, I was kind of waiting for it to play catch up, but it's not. There's something broken with the Russell 2000. Next thing I want to show you, this was a VIX chart, the fractal pattern that I was showing you, where we had our 1, 2, 3, 4. We popped up, came down, and this was the 5. Now, again, it doesn't mean it has to follow it exactly, but here's our 1, 2, 3, 4. Came up, came down, and now we had a big day. So is this what's going to be taking place after that? We'll wait and see, but it wouldn't surprise me if something just shocked the market and we had a big drop. But as I said, there's just this underlying bid on there and this euphoria that it's going to take something to really push things lower. So if we take a look at the daily chart on the S&P, this is the pattern that I was showing you with the S&P on the 15-minute chart. So this was the wedge, this was the target. You can see we're almost there. Now, the reason why that's important is if we take a look at the daily chart, it's the same pattern in play, and this is looking for a move to come someplace down into the 2700. But like I said, it's going to take a catalyst for that to get down there. What I was really looking for to be able to say that there's a pretty good chance that there's at least a short-term top in place was seeing the S&P take out the bull bear line, which was down at this 29.89. We did take it out. We have a gap right here at the 29.81. Maybe we find some buyers there, but more the likelihood is that we're going to come down into the next bull bear zone, and that's down at the 29.63 down to the 29.52. This is important because if we lose that area here, this is right, that support zone that I was talking about, we're going to get a very fast move, and the reaction trade should bring us down to the 29.10, 29.13. If the bulls lose that, there's really not a whole lot of support underneath here. You can see the huge bearish divergences. We know the risk index is still in bear market territory or correction. And, for that, we could really take back a lot of these gains in a very fast manner. But until we take this out, right now the short term was taking out the 29.88 level, which we did. This is the next level that the bears need to push through, and then more importantly, if they want panic to hit this market, they're going to have to take this bull bear line out here, because if they do, then I wouldn't be surprised to see us testing the 2800, and that's really been that's my target on this drop. If it does, if the top is in, which it could be, it would make perfect sense. I'm really looking for a move down to the 2800 level. It would just really wash out some of the weak longs, give some of the technicals time to just digest the moves that we've made, and actually maybe put a little more pressure on the Fed to actually cut a half a point. So it would actually make sense on it, and really with the bulls, what they're going to have to do, the first thing, if they get it above the 29 or say the 3000, we're going to get a reaction trade up to the 3007. Once we're up here, I think they're going to come up and test the highs. So we have the support levels 2964, 2953. Bears need to push it through that. If they do, then they're going to come down and test a 2910 bull bear line. And if that gets taken out, that's when we're going to be looking at some panic selling. So last thing I want to go over, we're in a program that we're with other, say, financial newsletters, and I get to see all these, and I get to pick and choose which I want to share with members and even free members on it. And this is one I read, and I found it very, very interesting. So it's not going to be coming out till tomorrow. I really do suggest that you guys take a look at this, see what it's all about, because it's really interesting, and we're going to be putting these out each week. We're going to really try to diversify things a little bit instead of just sticking just with the S&P. So when we find something that we like, because again, we're not really stock pickers, so we're looking for other people, other services to kind of join in, where they're allowed to use our market timing information. They give us their information that we can share, and kind of it's a win-win for everybody. But I'll be sending this out tomorrow. Be sure to take a look at it, and with that, enjoy your night, and I'll talk to you guys next week.